All right, let's talk Lowe's. They just dropped their Q2 earnings, and yeah, the numbers were good. They beat expectations. But honestly, that's not the real story here. The real story is a massive, nearly $9 billion bet that is set to completely change the future of this company. So let's dive in and break it all down.
Okay, so first things first, let's get the numbers out of the way. On the surface, Lowe's had a fantastic quarter. I mean, they beat what the analysts were expecting pretty much across the board, which shows some really strong discipline, especially in a housing market that's, well, let's just say it's still pretty sluggish.
And the headline numbers? They were definitely solid. Check this out. Adjusted earnings per share came in at $4.33, with revenue hitting almost $24 billion. Both of those numbers sailed past what Wall Street was forecasting. And look, this wasn't just them squeaking by. This was a real signal of confidence. But here's where it gets really interesting. One of the biggest wins for Lowe's was their comparable sales growth. It was up 1.1%. Now, that might not sound like a huge number, but it put them ahead of their biggest rival, Home Depot. And you can bet the CEO, Marvin Ellison, was all over this on the earnings call. He framed it as proof that their strategy is working.
So, the quarterly numbers were impressive for sure. But, like I said, that's not the thing that really defines this moment for Lowe's. The real market-moving news, the thing that got everyone talking, was a huge strategic announcement that they dropped right alongside the earnings.
So you're probably asking, right? What was the big story? Why did the stock jump over 2% before the market even opened? It wasn't just because of a solid quarter. No, it was all about the future.
An $8.8 billion move, to be exact. We are not talking about some small tuck-in acquisition here. This was a statement, a massive all-cash deal that is designed to completely reshape the company from the ground up. So what did they buy for all that cash? A company called Foundation Building Materials, FBM for short. Now, FBM is a top distributor of all the stuff that goes inside the building. You know, drywall, metal framing, insulation. It's the absolute bread and butter for professional builders.
And this acquisition? Well, this is where it all clicks into place. It's the keystone for their entire long-term plan. It's a massive bet that fits perfectly into what they've been calling their total home strategy. So what even is this total home strategy? Well, it's pretty simple. It's their big plan to be the one-stop shop for everyone, from the weekend warrior doing a little DIY project to the giant construction firm building a new development. And this FBM deal, it's like strapping a rocket engine to that professional side of the business. See, for the longest time, Lowe's has been the kingdom of the do-it-yourselfer. But this move, this is a huge, flashing neon sign that they are going all in on the professional customer. And why wouldn't they? The pros have bigger projects, they're planned out, and honestly, they represent a much more stable and predictable stream of revenue. And when you dig into why they bought FBM, it just makes perfect sense. First off, bam, it immediately plugs them into a $250 billion professional market. It also gives them crucial capabilities they were missing, like direct-to-job site delivery and fancy new tech. And it shores up their presence in key markets like California and the Northeast. From a strategic point of view, it's pretty brilliant.
And you don't have to take my word for it. The CEO himself, Marvin Ellison, called this a transformational move. Now, CEOs throw around buzzwords all the time, right? But transformational, that's a heavy one. It tells you they are betting the farm on this strategy.
And as if a nearly $9 billion deal wasn't enough news for one day, management is so confident in how their core business is running, they also went ahead and raised their financial outlook for the whole year.
So yeah, they bumped up their expectations for both sales and profits. And this is the important part. This improved outlook doesn't even include any potential impact from the FBM deal. This is all about pure confidence in their existing business. That speaks volumes.
Now you're probably wondering, how do you pay for an $8.8 billion shopping spree? Well, they're hitting pause on their share buyback program all the way until 2027. All that cash is now going to be used to aggressively pay down the debt from this deal. It's the responsible move, right? Prioritizing a healthy balance sheet over a short-term stock bump.
All right, so a solid quarter, a monster acquisition, raised guidance. Let's put on our analyst hats for a second. What does this all mean for Lowe's going forward? Here's our take.
Here at Talk Tickers, we're officially assigning an outperform rating. The catalysts are pretty clear. Number one, they have to integrate FBM successfully. That is non-negotiable. Number two, they need to use this new weapon to steal market share in the pro segment.
And number 3, the big wild card. What happens if the Fed starts cutting rates and the housing market gets a second wind? That would be pure rocket fuel for them.
And for those of you who like a more active approach, here's a trade idea to think about. Consider a long straddle on options expiring way out in January 2027. Now, full disclosure, this is a high-risk, high-reward play. You're basically betting that the stock is going to make a huge move, but you're not betting on which direction. If the FBM integration is a home run, the stock could fly. If they stumble, it could get ugly. A straddle is designed to profit from that kind of massive volatility. So when you boil it all down, this quarter was never really about a simple earnings beat. It was a line in the sand. It was Lowe's declaring a new, pro-focused future. The big question for investors now is, can they pull it off? Can they win the war for the pro customer? The next couple of years are going to be absolutely critical to watch. And as always, this is not financial advice.